You are standing in the kitchen of a house that is not yours. The listing agent is running late. Your phone is open to a mortgage calculator, and the number on the screen keeps changing every time you refresh it because the rate keeps changing too. $489,000. That was the asking price 2 weeks ago. Today it says $502,000. You do the math in your head. You have a good job. You have decent savings. So, why does buying this house suddenly feel like trying to catch a bus that just sped up? You close the calculator app. You open it again 30 seconds later, half hoping the number was a glitch. It was not a glitch. This is just what the market looks like right now for almost everyone standing in a kitchen like this one. Most people assume that a $500,000 home is a stretch goal, something you reach for once you are established, once your income catches up. But here's the real number. As of this week, the average 30-year fixed mortgage rate hit 6.69%, the highest it has been in over a year. On a $500,000 home with 20% down, that rate alone adds more than $300 to your monthly payment compared to just 12 months ago. The house did not get more expensive. The cost of borrowing did. My name is Marcus, and I break down what is actually happening to your money in an economy that keeps changing the rules mid-game. If that sounds useful to you, consider subscribing because I am about to walk you through exactly who can afford this house right now and who cannot, no matter how hard they are working. And I want to be clear about something before we go further. This is not a video about giving up on the idea of owning a home. It is a video about understanding the actual machinery behind that number on your screen, because once you understand the machinery, you stop blaming yourself for something that was never really about you in the first place. Let's talk about the myth first. The myth is that affordability is mostly about income. Earn more, save more, eventually you qualify. That is the story we have all been told since we were old enough to open a bank account. The story that shows up in every personal finance book written for a completely different rate environment. But here's the thing. Income has not been the bottleneck for a while now. The bottleneck is timing, and right now, timing is brutal. On Friday, the Bureau of Labor Statistics released the July jobs report, and it rattled a lot of people who thought the economy was stable. Payrolls fell by 23,000 jobs. Not grew. Fell. The unemployment rate actually dipped slightly to 4.1%, which sounds good on the surface, but that drop happened partly because fewer people were actively looking for work. Underneath the headline number, earlier months got revised down hard. More than 100,000 jobs quietly erased from what we thought had already happened. That is the kind of news that makes lenders nervous, and nervous lenders tighten standards, and tighter standards push rates up even further. It gets worse when you zoom in on where those job losses actually happened. Government employment dropped sharply. Leisure and hospitality dropped sharply. Retail dropped too. Meanwhile, healthcare and construction kept adding jobs, which tells you this is not a uniform slowdown. It is an uneven one, hitting some households hard while barely touching others. If you happen to work in one of the industries that is still hiring, you might not feel any of this. But if you work in one of the industries that just got hit, that $500,000 house you were saving for suddenly feels a lot further away than it did a month ago, even if your own paycheck has not changed at all yet. So picture a treadmill. Not a normal one. One that speeds up every single time you finally catch your breath. You save for 2 years, you finally hit your down payment number, and just as you step up to the machine, someone bumps the speed dial. That is what buying a home in this economy feels like right now. You are not standing still. You are running as hard as you can on a treadmill that keeps accelerating. Let's do the actual math, because numbers make this real in a way vague anxiety never will. Say you are buying that $500,000 home. You put down 20%, which is $100,000, leaving a loan balance of $400,000. At 6.69% over 30 years, your principal and interest payment alone comes out to roughly $2,579 a month. Add property taxes, homeowners insurance, and if your down payment were smaller, private mortgage insurance, and you are realistically looking at close to $3,100 a month going out the door. That is before utilities. Before maintenance. Before the inevitable week your water heater decides to die. Now compare that to renting a similar 3-bedroom place in most mid-sized American cities, which right now averages somewhere around $2,100 a month. That is a gap of nearly $1,000 a month between renting and buying at today's rate, on the exact same square footage. That gap is not a coincidence. It is the direct result of a 6.69% rate sitting on top of a home price that has not adjusted downward nearly as fast as borrowing costs have climbed upward. Renters are not choosing to rent because they lack ambition. Many of them are doing simple math and realizing that buying right this month does not pencil out, and that is a rational decision, not a failure. There is also a version of this math that surprises people in the other direction. If you already own a home you bought back when rates sat around 3 or 4%, you are effectively locked into one of the best financial decisions of the last decade, and moving right now would mean trading that low rate away for something closer to 6.69% on your next place. That is part of why so few existing homeowners are listing their homes this year. They are not attached to the walls. They are attached to the rate. Now here is where it gets specific. Meet Danielle. She is 31 years old. She works as a marketing coordinator in Charlotte, North Carolina, and she brings home $4,900 a month after taxes. Her rent right now is $1,600. Her car payment is $385. Groceries and gas run her about $600 a month. Student loans take another $290. Add minimum debt payments, subscriptions, and basic living costs, and Danielle has roughly $1,100 a month left over after everything. To comfortably afford that $3,100 monthly payment on the $500,000 home, most lenders want your total housing costs to stay under about 36% of your gross income. For Danielle, that would mean her housing payment needs to stay under roughly $2,300 a month, not $3,100. She is not just short. She is nearly $800 a month short, every single month, for 30 years straight. And Danielle is not underemployed. She is not bad with money. She has been saving consistently for 3 years. She just happens to be trying to buy a house in the exact month the treadmill sped up again. Let's also look at what happens if Danielle waits. Say she holds off for 18 months, keeps saving that extra buffer, and rates ease back down to somewhere around 5.9%, which is not an unrealistic scenario if the labor market keeps softening the way July's report suggests. On that same $400,000 loan, her principal and interest payment drops from roughly $2,579 to around $2,370 a month. That is a difference of over $200 a month, more than $2,500 a year just from timing. Danielle is not bad at math. She is trying to hit a moving target with a stopwatch that someone else controls. This is the part one really want you to sit with because it is not your fault. It is easy to internalize a number like this as a personal failure, as proof that you did not work hard enough or save aggressively enough. But zoom out for a second. The Federal Reserve has kept borrowing costs elevated to fight inflation that most working people did not cause. The same week rates climbed to their highest point in over a year, the labor market started showing real cracks, with payrolls shrinking and prior months getting revised downward by over 100,000 jobs combined. Wages for most workers have not kept pace with the speed at which housing costs and borrowing costs have moved. Average hourly earnings did tick up slightly this past month, but that increase is tiny compared to the jump in what it now costs to borrow $400,000. You are not failing a personal math test. You are running on a treadmill that a small number of policy decisions keep speeding up, and almost nobody running on it has a hand on the dial. Think about how many separate decisions had to line up to create Danielle's exact situation. The Federal Reserve's rate policy, government hiring freezes at the local level, a national jobs report that spooked bond markets on a random Friday in August. None of those decisions were made in Danielle's kitchen. None of them show up on her resume. Yet all of them show up on her mortgage calculator every single time she refreshes the page. So what actually helps here? First, stop measuring yourself against a $500,000 number that assumes today's rate is permanent. Rates move. Homes that do not work at 6.69% can work at 5.5% if you refinance later, and buyers who purchase now with a plan to refinance in a couple years are not being reckless. They are being strategic. Second, look sideways, not just up. Homes in the $300,000 to $400,000 range in growing metro areas often carry payments that are $700 to $900 a month lower, And that gap is exactly the buffer someone like Danielle needs. Third, remember that a slowing job market usually cools home prices too, even if rates stay high, because sellers get nervous and buyers get pickier. That treadmill speeding up in one direction often slows down in another. Fourth, and this one gets overlooked constantly, ask about rate buydowns and seller concessions before you assume a house is out of reach. In a slower housing market, sellers who need to move are often willing to pay down your rate by a full percentage point or more just to close the deal, which on a $400,000 loan can mean saving over $200 a month without you spending a single extra dollar on the purchase price. Nobody advertises this loudly, but in a market like the one we are in right now, it is one of the most underused tools available to a buyer. None of this means the number stops matching. It means the number is not a verdict on you. It is a snapshot of a specific, temporary, and frankly unstable moment in the economy, and snapshots change. If this video helped you make sense of what is actually happening with your money right now, hit subscribe because I break this down every single week. No fear-mongering, just the real numbers and what they actually mean for people like you. Danielle is going to be fine, by the way. She adjusted her plan. She looked sideways instead of just up, and she is still moving forward, just on a slightly different timeline than she pictured a year ago. So are you. I will see you in the next one.